Hi everyone, my name is Tan Junyan and my matrix number is 311734. To better understand a company's financial statements result over time, companies can use ratio analysis. Ratio analysis is a financial tool used to assess a company's performance by comparing financial data from its statements. This can be used to determine the company's strengths and shortcomings. Moreover, this analysis can be used to understand their financial performance and business strategies. In this assignment, we will compare the financial performance of two companies, which are the KLCC Property Holdings Berhad and Kuchai Development Berhad. KLCC Property Holdings Berhad is mainly involved in property investment, asset management, and credit operation. The company owns and manages major commercial properties in the KLCC area, generating income primarily from rental and real estate investment. For Kuchai Development Berhad, its main activity is investment holding. The company earns income through investment in shares, funds, and property rentals rather than property development. Both companies are belongings to the same category, which is property investment. The purpose of this analysis is to compare the performance of two companies from the liquidity, asset efficiency, profitability, and solvency. So at the end of the assignment, we can determine which company performed better after the comparison.
Hi to doctor and all my teammates. My name is Lao Chi Xiang and my metric number is 312175. So I start with the first financial ratio category, which is liquidity ratio. Under this category, we got two ratio, which is current ratio and quick ratios. So we go for current ratio first. Current ratio is calculated by using the current asset divided by the current liabilities. And if it is above 1, which means the company is able to pay their short-term debt by using their current assets. So we'll go for KLCCP first. For KLCCP, their current ratio is 3.9555 to 1, which means almost 4 ringgit of current assets to 1 ringgit of current liabilities. And actually this shows a healthy and strong stage of liquidity for KLCCP. Although it is slightly higher than normal operation business, which is between 1.5 to 3, but for KCCP, it is acceptable because it is a company that mainly invested in property and real estate. So my suggestion for KCCP is they should continue to monitoring their short-term liabilities and invest their current assets into productive or potential economic projects to make sure their current ratio is in the strong stage. And for Kuchai's the current ratio is 65.25 to 1, which means they have 65 ringgit 25 cents of current assets to 1 ringgit of current liabilities. Although it is more than 1, which means they're able to pay their short-term debt, but it is extremely high and show an unhealthy stage of current ratio because this is show that the company unable to use their or utilize their assets to gain in order to gain a bigger returns. So my suggestion for Puchai is they should allocate their excess cash into their long-term investment in order to improve return and the overall efficiency for current ratios.
My name is Lim Jarong and my metric number is 310305. I represent about quick ratio. The quick ratio shows company's capacity to use its most liquid asset to satisfy its short-term obligation. For KLCCP, its quick ratio is 3.96 over 1. This means KLCCP has a quick ratio of 3.96 ringgit asset for every 1 ringgit liability. This is a firm liquidity position since the company can easily cover its short-term liabilities using its cash and short-term investment. To improve the quick ratio, company can continue monitoring short-term liabilities and invest any quick assets into productive project to avoid idle liquidity. For Kuchai, its quick ratio is 64.59 over 1. This means Kuchai has a quick ratio of 64.59 ringgit asset for every 1 ringgit liability. This ratio is extremely high, indicate the Kuchai might be holding too much liquid fund or spare cash. Kuchai can allocate their liquid asset such as cash into new development project. Both company indicate sound liquidity, but Kuchai extremely high quick ratio indicate the company hold too much cash or short-term asset that could otherwise be invested to generate return. Overall, KLCCP have more efficient liquidity management.
Hi everyone, my name is Lu Ziying and my metric number is 3117767. Now we will move to second financial ratio, which is the activity ratio. Activity ratio measures how efficiently a company uses its asset to generate sales and manage its daily operations. There are two ratios under this category, which is total asset turnover and account receivable turnover. Now, total asset turnover. Total asset turnover measures how efficiently a company uses its total asset to generate sales revenue. As we can see, KLCC property perhaps gets 0.1764 times. That means KLCC property perhaps generates RM 0.1764 in sales for every 1 ringgit of total asset. This ratio is quite low, but it's normal for a property company because this industry requires heavy investment in long-term assets such as buildings, malls, and office towers. These assets take a long time to generate revenue. After that, Kuchai Development Berhad, as we can see, it gets 0.03 times. That means Kuchai Development Berhad generates only 0.03 ringgits in sales for every 1 ringgit of total asset. This is even lower because Kuchai mainly focus on investment holding and leasing, and many of its assets are long-term investment that do not generate high yearly revenue. As suggestions for the ratio to be improved, KLCC Property perhaps can increase occupancy rates by introducing targeted marketing program to reduce vacancy rates and improve revenue from existing assets. Meanwhile, Kuchai can develop its vacant land into commercial buildings or residential areas in order to increase the leisure portions.
Next, we talk about account receivable turnover. The account receivable turnover ratio is an asset efficiency measure that shows how effectively a company collects its credit sale. For KLCCP, its ratio is 7.77 times. This means KLCCP collect its credit sales 7.7 times per year. This ratio is a bit low, measure that KLCCP had low risk of bad debt and cash flow problem. To improve the account receivable turnover, KLCCP can implement automated billing system and digital reminder to speed up collection process. For Kuchai, its account receivable turnover is 15.66 times. This means Kuchai collect its credit sales 15.66 times per year. This ratio is high because the average receivable is small compared to the net sales. This shows the Kuchai is efficient at collecting payment from its customer and has a low level of outstanding receivable. To improve the account receivable turnover, Kuchai can use electronic invoice and online payment system, which can shorten the company collection cycle. Overall, KLCCP is much slower in collection, while Kuchai development look more effective in converting credit sales into cash.
So now we're going for the third category of financial ratio, which is profitability ratio. Under this category, we got two ratio, which is profit margin on sales and return on common shareholder equities. So we'll go for profit margin on sales, which is the first ratio under the profitability ratio category. This profit margin on sales is calculated by using the net income divided by net sales and multiplied by hundreds in order to get a percentage answer. So this ratio is used to measure a company profits in their each sales. We'll go for KLCCP first. For KLCCP, their profit margin is 61.79%, which means KLCCP earn 0.62 ringgit of profit per 1 ringgit of sales, and this mirror a very efficient operation because for property company like KLCCP, they need a very strong control of cost and also a very stable income in rental to make sure their profit margin is in a strong stage. So my suggestion for KLCCP is they should maintain their current pricing and cost control strategy. And in the meantime, they should exploring more ways to increase their revenue streams to further enhance their profitability. And now we go for Kuchai. For Kuchai, their profit margin is 107.89%, which means Kuchai earn more than 1 ringgit profits in each of their 1 ringgit sales. And this extremely high profit margin show that Kuchai earn their profit not from their operation but from investment. And actually, this is not sustainable. Even it is high and strong for Kuchai financial, but it is not. It is quite risky for Kuchai because it will be insecure for long term. So my suggestion for Kuchai is focus on building a stronger operational income and diversify their revenue source, so their performance is not over in dependent on the investment.
My name is Chu Yong Yong and my matrix number is 311776. Now, I will explain the return on common shareholders equity, which is ROE, for both company KLCC Property Holdings Berhad and Kuchai Development Berhad. ROE measures how effectively a company uses shareholders' equity to generate profit. For KLCCP, the ROE is 7.27%. This means KLCCP generates about 7.27 cents of profit for every 1 ringgit of shareholders' equity. This shows moderately strong profitability, and the companies could further improve by enhancing operational efficiency and adopting more efficient technologies. For Kuchai Development, the ROE is 3.26%, which means it earns only 3.2 cents for every 1 ringgit of equity. This indicates low profitability and weak earnings performance. To improve, Kuchai should reduce unnecessary costs and strengthen management practices. Overall, KLCCP performs better with a more efficient use of equity and stronger returns for shareholders.
Now, moving on to the fourth financial ratio, which is leverage ratio. Leverage ratio measures how much a company relies on debt to finance its asset and operation. Under this category, there are debt to asset ratio and debt to equity ratio. Now, move on to debt to asset ratio. Debt to asset ratio measures how much a company total assets are financed through debts. As we can see, KLCC Property perhaps gets only 0.083461. That means KLCC Property perhaps is financed by RM 0.083 of debt for every 1 ringgit of assets, which means only 8.34% of its assets came from borrowings. This is a very low gearing level, showing that KLCC Property perhaps has a strong solvency and low financial risk. Now, move on to Kuchai Development Berhad. You can see that it gets 0.005 to 1. That means Kuchai Development Berhad is financial by only RM 0.005 of debt per 1 ringgit of assets, which is just 0.5% of its assets came from borrowings. This means that this company is almost completely equity financed, which that it has a very minimal reliance on debt to improve a better and efficiency debt to asset ratio. KLCC Property perhaps can evaluate underutilized asset and redeploy them into higher yield projects to improve overall capital efficiency for better debt to asset ratio. Meanwhile, Kuchai can consider to take on strategy borrowing to finance development or redevelopment of existing properties to generate higher revenue.
Now I will explain debt to equity ratio for KLCCP and Kuchai Development. The debt to equity ratio assesses how much of a company's financing come from creditors compared to owners. It compares total debt with total shareholders' equity, and a higher ratio means more reliance on debt and higher financial risk. For KLCCP, the ratio is 0.36 to 1, meaning that for every 1 ringgit of equity, KLCCP uses 36 cents of debt. This is low and indicates a sound and conservative financial structure. KLCCP could still take on moderate additional debt to support future growth. Kuchai Development has an extremely low ratio of 0.005 to 1, meaning it uses almost no debt at all. This shows very low financial risk, but company might improve capital efficiency by introducing a small and controlled amount of debt. In summary, both companies have low financial risk, but KLCCP uses debt more effectively, while Kuchai remains extremely conservative.
To conclude the analysis, Kuchai's development Berhad's highly conservative, low-risk strategy construct with KLCC Properties holding Berhad's more balanced and efficient use of assets, while Kuchai Development Berhad's prioritize safety at the expenses of growth. KLCC Property Holdings Berhad make better use of its resources more effectively to generate stronger returns and consistent profitability. To summary, Financial performance of KLCC Property Holdings Berhad is better than Kuchai Development Berhad.